While retail investors focused on daily price swings, institutional capital quietly triggered a massive rotation out of European equities. A sudden convergence of geopolitical instability and a sharp global technology sell-off is forcing global portfolio managers to re-evaluate their exposure to continental assets. The risk premium for Eurozone equities is shifting rapidly, signaling that the era of easy valuation expansion has run into a wall of physical reality. To understand why Europe's tech sector is the epicenter of this sell-off, we must look at its core structural moat. Giants like ASML and SAP form the absolute backbone of global digital infrastructure. ASML has a near monopoly on extreme ultraviolet lithography systems. SAP runs the back-end operations of the world's largest enterprises. But these moats are no longer insulated from macro disruptions. This vulnerability extends beyond technology into luxury and industrial sectors. Consider LVMH, a business built on ultimate pricing power and global brand equity. When global markets panic, these premium consumer discretionary anchors serve as an index proxy for European economic health. If institutional investors decide to trim risk across the entire continent, even the strongest consumer moats suffer from indiscriminate capital outflows. Let's examine the underlying financial metrics of this shift. Over the last quarter, corporate margins across European tech leaders have begun showing structural compression. While top-line revenue has remained stable, rising operating expenses are biting. ASML reported solid shipments, but booking momentum is slowing down. The market is highly sensitive to any degradation in net new order intake. This margin pressure is visible when looking at the relationship between capital expenditures and net profit margins. SAP has managed to accelerate cloud revenue growth, yet the cost of cloud transition is keeping margins under pressure. When we analyze the aggregate performance of the Euro Stoxx indices, it becomes clear that valuation multiples are adjusting to lower bottom-line visibility. Corporate leadership teams are actively managing expectations in their latest public statements. ASML management has described the current environment as a transition period, highlighting customer caution in committing capital. This matches what we are seeing across global hardware suppliers. Major customers are delaying lithography tool installations, choosing to optimize their current capacity instead of expanding frantically. This strategic caution is reshaping corporate capital allocation. Instead of aggressive share repurchases, companies are focusing on cash preservation. At LVMH, management is monitoring changing consumer behavior patterns globally. They are shifting capital allocation toward strengthening existing supply chains rather than building out physical retail networks. This signals that defensive positioning is taking priority over raw growth. The broader macroeconomic environment acts as a massive headwind for these companies. Recent Middle East tensions have introduced major shipping and energy risk premiums. This development acts like an indirect tax on European industrial and logistics chains. When global shipping routes are disrupted, component delivery timelines stretch out, directly impacting production schedules for advanced technology hardware. We are also watching a widening transatlantic spread. Institutional asset managers are increasingly rotating capital out of European tech and into US-based equities. The perception of higher energy security and superior structural demand in North America is drawing liquidity away from European bourses. This flow of capital is leaving European indexes structurally vulnerable to further valuation contraction. This brings us to the acute risks facing the technology sector's operating model. The semiconductor supply chain depends on specialized materials that are highly vulnerable to transport disruptions. If critical raw materials are delayed, manufacturing output drops. ASML is highly dependent on global shipping lines to transport its massive machines. Any prolonged logistical friction will immediately hit quarterly revenue recognition. Another structural threat is currency volatility. With European tech and luxury brands generating the bulk of their revenue outside of the Eurozone, fluctuations in major currencies can erase gains. SAP must navigate foreign exchange exposure as its enterprise software contracts are priced worldwide. If the euro weakens or strengthens dramatically, it complicates forward margin planning and distorts raw quarterly comparisons. Looking ahead, forward earnings visibility requires a realistic valuation reassessment. Portfolio managers are shifting luxury brands like LVMH to a trim consideration if their pricing power cannot keep pace with rising inflation. The consumer discretionary space cannot easily absorb rising costs when global demand softens. This suggests that near-term valuation multiples may continue to settle lower. However, this transition is also creating long-term structural momentum opportunities. We are putting key enterprise technology players on a breakout watch. As software migration continues, SAP benefits from recurring cloud revenue models that are highly resilient to geopolitical spikes. Once macro volatility stabilizes, these high-moat software businesses will likely be the first to attract institutional inflows. Let's summarize our tactical playbook. First, we must recognize that geopolitical friction acts as a systemic risk multiplier across European equities. We are carefully adjusting our exposure to semiconductor hardware, keeping ASML on a close watch list. Second, we are prioritizing resilient software business models over cyclical consumer luxury until global logistics and energy pressures ease. Navigating these shifting structural dynamics requires an institutional-grade framework. Make sure to subscribe to SR Money News for deep, non-consensus insights. Hit the notification bell so you never miss our deep dive corporate and macro analysis. Let us know in the comments how you are positioning your global equity portfolio to handle this macro volatility.